Hello, everybody. Had to grab my coffee. Brian Stevens here with Mortgage Shots of the National Real Estate Post. I hope you're all having an absolutely fantastic time today. I hope you had a good week. We talked about this on Monday. We need to really just understand there are certain markets that you need to sprint in, and there's certain markets that you can walk in. Right now, we're at a time to sprint. We're at a time to sprint because this market is changing right before our eyes. We're not about to. We are in the midst of doing it, and you're going to either enjoy the fruits of your labors in the coming markets, or we're going to find ourselves in a personal recession. So what we want to do is just understand that the actions that we take today are really going to have an effect when the market changes, and we're going to start to see significant changes right now. And I've been going over it this past week. If you have not seen, go back to Mortgage Shots, which is my show, and check out what we've talked about, because there's a lot of evidence right now, anecdotal evidence out there right now, that would suggest that our market is going to get a little bit better. We have a whole bunch of great stuff that we're going to talk about today. We got a bunch of graphs, which are going to discuss, some of the pillars. We're going to check boxes looking at graphs and figure out what we can extrapolate from that. But I want to start with this because I thought this was really pertinent, and let's jump right in. Okay, what we're looking at here is delinquency rates on single-family mortgages. This is, we're looking at this over the past year. Have we noticed anything? Our seriously delinquency rates, they've gone up. Now, it doesn't look that big. It's 1.73, and it's gone up to 1.79. And if we were to take this graph and look at this over a longer period of time, which we can certainly do, we'll see an ebb and flow that goes back and forth. So I'm going to take this, and we're going to go this out to a 5-year period. And you can see, of course, 5 years ago, back in 2020 during COVID, we had higher numbers and we've gone down. If we look at it, this is a 1 year, we are certainly trending up. If we look at this over a 10-year period, we have gone down. But if we max this out, check it out. We saw delinquency rates go absolutely through the roof here. And you notice how quickly this skyrocketed. It started out very short. We see this little tiny bump here. And then boom, we lit the jets and we went up into outer space, didn't we? Now, this, of course, is the Great Recession. And then afterwards, everything came down. Values, by the way, are proportionally opposite to delinquencies as well. Does that make sense? Values are proportionally opposite of what you're looking at. So when we see our delinquency rates going through the roof here, that means our values are dropping equally. When our delinquencies go down, our values go up proportionally the same. Now you see our delinquencies went down here. We saw this little bip. This over here is COVID, which, by the way, if we look at this on a 5-year period, it's a pretty big bump. This big bump over here on a 10-year period, a little blip right here. But when we look at it in a shorter time frame, it's huge. Okay, so our delinquencies have gone down. However, I think what we're going to see if we look at our delinquencies on a 1 year, see how we got this little bump going up here. The question we have to ask ourselves is that little bump over here, which looks like the little bump over here on a shorter period, are we going to see the same type of stratosphere rise in delinquency rates? And right now, I'm going to show you some other graphs here. It certainly seems like that is on the horizons for us. Okay, what we're looking at here is all consumer loans. Here's our delinquency rate, and this is going back to 2020. This is why we should be concerned about mortgage delinquencies. I just showed you a couple of graphs. You're like, Brian, that's not that bad. Aha. People are going to make their mortgage payment before they make their credit card payment. What's going on with their credit card payment? What's going on with their installment payments? Well, here's what we're looking at over a 5-year period, and you can see that this thing has gone up drastically, significantly. So this falls before mortgages fall. So is this a canary in the coal mine with our delinquencies on consumer loans? You be the judge of that. This is our delinquencies on credit card loans. Isn't it interesting how our credit card loans look a hell of a lot like our consumer loans? This is going to be installment loans and all those other ones. This is our credit card debt. What's happened with credit card debt delinquencies? And again, we've gone through the roof on these as well. Now, if we're going to go ahead and pull this out over a longer period of time, so we are looking at a 5-year period, so let's look at 10 years. That's pretty stark, isn't it? In fact, when we look at our credit card delinquencies, check us out. This was during the Great Recession, right before the last massive precipitous fall off when mortgages absolutely tanked. Do you notice that our credit card delinquencies are higher today than they were before the delinquencies of the Great Recession? So we know when we had delinquencies back in 2020, let's go back here to 2008. In 2008, we were significantly higher, weren't we? But when we saw our last recession over here, our COVID recession, we are significantly higher than that. And in fact, this may not seem that high, but our credit card delinquencies are certainly going to play a problem in terms of what we're doing. If we go to a 1-year period, it looks like we're going down. If we look at it over a 5-year period, well, our delinquencies have gone up significantly. And again, this is credit card debt. We're currently holding about $1.8 trillion in credit card debt. So if this falls, it's going to be problematic for everything. Okay, what we're looking at here is our personal savings rate. This is our personal savings rate over the past year. I believe this is a year. Yes, this is over the past year. What's happened with our savings rate? It's low, isn't it? It's not good. If we look at this over a 10-year period, our savings went up, okay? And then in 2021, we saw a little bit of savings here, and we've dropped off the map. This is problematic for us because, once again, we don't have money in reserves in the event we find ourselves in harm's way. Does that make sense? What we're looking at here is our home ownership rate in the United States. Does everybody deserve a house? I don't know. But right now, over the past 5 years, we have the lowest home ownership rate that we've had. Once again, let's pull back out and look at this over, here's our home ownership rate over a 5-year period. Let's look at our home ownership rate over a 10-year period. 2020, again, this is during COVID. People were buying a lot of houses. This is when we were nesting. This is when we didn't have to go into work. And look at our home ownership rate dropped off. Now, if we look at our home ownership rate over, so this is going to be 1960, so we're looking at about a 60-year period. Our home ownership rate sitting here seems like it's right at about the median, but we are definitely trending once again in the wrong direction. The question then becomes, at these prices and these rates, with the amount of credit card debt that we're holding, with the fact that people are starting to fall behind and we are starting to find cracks in the dam, do we anticipate that this number is going to continue to go up or go down with home ownership rate? Here's where we're at right now. In a 1-year period, if we look at it on the max, it looks like we'll probably fall back down to somewhere in the mid-90s. Now what we're looking at is our 30-year fixed rate mortgage, and we're going back to 2015, so this is going to put us at 10-year period. Okay, so if we're looking at our average mortgage rate, we are pretty much higher than we've been over the past 10 years. The problem is our market is based on this 2.65%. Our values are based on this 2.65% rate. Again, proportionally, this is when we saw home ownership go significantly up. It's when rates drop down during COVID and everybody bought a house. Remember that spike on home ownership? Let's see if we can find it here. Here's our spike in home ownership. Why do we have the spike in home ownership over here? Let's go back over here to mortgage interest rates. It's because rates went down. This went down proportionally to home ownership going up. Now look what happened with interest rates. We went from 2.67% on average in a very short period of time back in 2021. And if we go over here to 2023, we're sitting at 7.76. We went up over 5% in a very short period of time. Do you see how our mortgage interest rates went up 5% over this 2-year period of time here that we're looking at? See how that goes up? If we go back over here, that was going up as this was going down. When rates were going up, we were going down. Okay? When rates are going down, home ownership's going up, and vice versa. Okay, what we're looking at is new privately owned housing units authorized for permits. So here's what's happened with our permits. Now going back here, this is 2008. These are all this is a buildup to the Great Recession here. Look at how housing permits are future houses to be built. Now what we saw is rates going up, our subprime loan debacle, our FHA loan debacle, and our foreclosure debacle for the Great Recession, and our home ownership rates dropped significantly, didn't they? And our permits dropped significantly. Now, after this, we saw our boom, and permits went up. And what are we doing right now? Well, our permits are dropping off a cliff. Again, this is going back to over a maximum period of time. If we look at this over a 1-year period of time, what's taken place with permits? Permits have gone down, and we can expect to see this number to continue going down as we move forward. Okay, this is a very interesting one, isn't it? This is the reason for home ownership. You can make all the arguments that you want in the world why you shouldn't own a house. But the truth of the matter is when you buy a house, that first payment should be the most you ever make for your housing expense payment as long as you own that house, because you have stopped inflation on that property permanently. As you receive raises, your monthly mortgage payment is going to become a smaller portion of what your pay is, meaning your payment will effectively go down. The opposite is true of rents. Now, here's rents back now, and they're saying rents are more affordable now than ever. Rents are going down. People can't afford to buy houses. All these properties that are being built, they're being built to rent. Rents are going down. Well, look at what's taken places from rents. This is going back to 1945. From 1945 to today, tell me where in here we have any type of logical, defensible position to tell somebody that their rent payments in the future are going to go down. You don't need to buy a house. Just rents are going to come down. Look at all these rental properties. Look what Minnesota did. They built all these fantastic rentals for everybody. Isn't this great? Rents are going to come down. Now, I want you to look at a graph here. Now, this is from the St. Louis Federal Reserve. Tell me over a nearly 100-year time span, what would make you suggest rents are going to do anything but continue to go up? When you buy a house, what takes place? We know what takes place. It's going to fix that, and that first payment should be the highest you ever pay. And of course, we didn't even discuss refinances there. For loan officers and real estate agents who have clients who are vacillating on the fence right now, and they just, I don't know if I want to buy a house, this is the graph you should show them. This is from the Federal Reserve. Here is your future with rents. Okay, now this is inflation. How are we doing with inflation? So inflation, this is back during Volcker, when Volcker was the head of the Federal Reserve, and we saw mortgage interest rates of 18%. This is when Volcker raised the Fed fund rate, 5% over the course of a month like a lunatic, and freaked everybody out. And what we saw is 40 years of low inflation because Volcker was crazy. Now what we see over here with Jerome Powell, this is Volcker light. So Volcker went over there and continued, as we saw over the past couple of years, continued to raise the Fed fund rate to try to get inflation under control. And you can see he didn't do it as well as Volcker. We didn't go as high as Volcker, but we went down. So this is Volcker light. This is Volcker 2.0. This is Volcker 1, the biggest inflationary bubble we've ever seen and the biggest drop. Here's my question to you, and I'm dead serious about this. So right now we have inflation, which I guess if I'm going to stink eye this thing, over the past 60 years, I'm going to say we're sitting right around average. Our inflation is neither high or low. But to me right now, does it feel like to you that everything is just more expensive and difficult? My wife and I were talking about this today. I said, you know what? These restaurants are not going to re-laminate menus and drop prices. They've laminated the new higher prices, and we're going to have to stick with it. You see, inflation is something that is fluid. It continues to move. What we have is we have the higher peaks of inflation, and I simply don't see the cost of goods going down across the board. Of course, energy can go up and down like gasoline. Food can go up and down if you're buying it from grocery stores, of course. But if you're going out to eat, if you're buying cars, if you're buying houses, these are kind of fixed at higher rates, and I simply don't see them going down. My question to you is do you feel like inflation has come down to a point that reflects this graph? Are your clients at a point to where they feel inflation reflects this graph? I'm not sure if that's the case for me. And finally, we have this one. This is consumer sentiment, how consumers feel about things. And this is going to go back over the past 10 years. Our sentiment over on the right-hand side is ranked at 58.2. What does that mean, Brian? I have no idea what it means. But what we can do is compare it against different numbers to see good sentiment and bad sentiment. And what I can tell you over the past 10 years, the only time we've seen lower sentiment is going to be back a few months ago in April of 2025. And of course, if we go back here to June of 2022 at a 5.0, we are currently sitting at a 5.8. Again, this is at a 10-year period. Right before right before COVID, we were sitting at 101. So we're about 20% lower than we were then. And if we are going to go ahead and pull out and look at this over a maximum period of time, our sentiment is down here. And if I stink eye this thing, people don't feel good about where they're at or the direction our economy is going right now. That's why when I look at inflation, I say inflation looks pretty flat. Well, I'll tell you what, consumer sentiment, how people feel about inflation and feel about their finances, does not reflect the fact that our inflation has gone down. This is the reason why buyers are sitting the fence. They're looking at the market, their sentiment is down, and they're saying, we think this market is going to continue to drop. The question is, what do you think? Should somebody buy right now, or should they continue to sit the fence? Are rates going to go down? They could. Are values going to go down? They could. Do we want to wait for them to come down? Maybe we should. Maybe we shouldn't. I don't know. That's your decision. Listen, guys, I hope this helps. If you have any questions, obviously leave them in the comments down below. Like and share and all that good stuff. And with that said, you enjoy your weekend. Go Niners. I can't believe they're winning. And watch the meteor shower. That might be kind of fun.